Okay, you have a property in mind, or you have something that you want to find out. Maybe you want to find out how much home you can afford. How much your mortgage payments would be if you were to buy said amount of home. This is the rub. We need to find this out. But unlike Peter McKinnon, I'm not going to say that we're going to go 2 minutes on the clock. Instead, I'm going to walk you through it on this episode of TNT. Okay, we have the website up here. As you can see, we've gone to dennismaynard.com. Why did we go to dennismaynard.com? Because that's where the mortgage calculator is. So we go into the section of buyers and we hit mortgage calculator. And this interesting screen comes up. Some of these things are pre-filled, so you will have to you can make changes to just about anything. So hypothetically, let's say as we scroll down that we're gonna buy a property worth $1,200,000. No commas added, unfortunately, but it'll work out, I promise. And we're gonna put 15% down, okay? Look at how the numbers automatically change. It tells us a bunch about what it is that we are expecting in monthly payments. The interest rate is preset. That gets adjusted pretty regularly, about once a month. So it's approximately accurate. So it's not going to be a definite. This is not the same as a pre-qualification. You do have to get pre-qualified and get pre-approved in order to have a finite, more finalized version of what your payments are going to expect it to be. And that will not happen until you're under contract and you have made an offer. Make sense? So all of this is a accurate guesswork until that moment in which we know for sure what it is we're buying, where we're buying it, and how much it's going to be. But this will give you the estimate. As you can see, we went down and here is the monthly payment, interest, and principal. Because some of these, this is a 15% down payment, we do have monthly PMI. Now, as a general rule of thumb, payment mortgage insurance goes until you hit the 20% down threshold. So with this particular calculator, and I'm telling you this in advance, if you put in 20% down, it's still going to calculate it in there. So you have to zero it out. Now you're getting to your true payment, right? But the question is, let's say that I am only making X amount of dollars annually. Well, $40,000 on $1.2 million ain't gonna cut it. This isn't 2006, 2007. But let's say that I know that I am making a monthly nut of $10,000 a month. One too many zeros. Now, am I gonna qualify for the loan? No. According to this, the maximum loan amount that you'll be able to allow due to the current debt to income ratio is a negative. But if you're making $15,000 a month, you're probably going to get the loan. Why? Because the maximum amount that lenders will typically look at for a mortgage is 40% of your monthly income, your gross income. So that means that after taxes and everything else, you're not going to be allowed over a certain threshold. That threshold is even more likely to hold true if it's under 40 and closer to 35. So you're using 35% of your gross income towards making a payment. Some of you are going, well, I don't make $15,000 a month. Yes, you may not, but how most people are affording homes in Los Angeles is they're using combined income. So between a husband and a wife or two partners, they may make $15,000 a month pretty handily. So how do we also take into account our monthly debt? Well, there's a little thing right here, monthly debt payments. So you do not want to include your utilities. You don't want to include anything like that. They're basically just looking at what's your auto payment. Do you have any outstanding credit card debt? And a lot of times when you're working with a mortgage broker, they're going to say, hey, listen, I need you to pay down a credit card really, really fast. Just pay off this $2,000 credit card, and then you'll be in a better shape, or whatever amount it is. And by paying off debt, let's look at how that affects it. Let's say we have 2 car payments at $500 a month a piece, and we won't even add in credit card debt. See how the debt to income ratio went up? It's quite a bit, isn't it? Well, let's say we add in credit card debt on top of that, and that totals out to be $2,500. That just drastically altered your ability to get a mortgage because you're carrying too much debt. And that's how you know what it is exactly that is happening. Now listen, there's some cool functions on this. I want you to be aware of it. Let's say you want to see an amortization schedule, we can do that too. But I'm going to take this down. I'm just going to say it's $1,500 a month in debt. You're probably going to get the loan. Let's say you want to see what it looks like and how your payment breaks down. Push that amortization button and voila, you have one really beautiful amortization schedule that goes into your annual pay down, your interest, your payments, and how it reduces over time. Pretty cool, huh? And that, my friends, is how you calculate how much you can afford. So, let's say you just wanted to find out how much you can afford based on what you earn. If you just zero out this up here, the purchase price, your maximum qualifying loan amount is $1,298,000 if you were to put 20% down. And that's how they calculate it. I'll slow down here just a little bit and you can see it one more time. That's it, guys. That's how you can do a quick figure it out on the back of the napkin. If you need my help, please reach out. I'm happy to answer questions about pre-qualifying for a loan and connect you with a fantastic mortgage broker. And again, remember, we help people buy and sell homes very quickly for the best deal that they can possibly get. I look forward to speaking to you again, and this is TNT. Hit me up if you need me.